So today we're going to be talking about inflation, why it's a good thing to understand in terms of investing, and sometimes why saving money isn't necessarily the best in certain economic times. So inflation can go based off a bunch of things, but normally what people look at is the consumer price index. So this is how much things have actually increased in price over time, and this kind of all falls down to inflation at the end of the day. The reason that money inflates is mainly due to, if you're going for an overall view, the debt that countries actually accumulate. They need to print more money to actually pay off those debts. And this kind of is a revolving door around the world. So all countries come into debt to different countries, and they are in debt to other countries. And it is a revolving door of them having to print more money, which inflates the cost of everything else, and also diminishes your purchasing power of the money that you have day by day or year on year. So as we can see here, we have a 12-month percentage change consumer price index. So we're going to be kind of referring to both the CPI and inflation rates kind of the same in this regard. But let's just go for this. This is from the Bureau of Labor Statistics in the US. So this is their reported CPI that they have here. So you can see this massive spike up to around 9% back in 2022, and it's come all the way down to around 2.7%. I know the Fed have their interest rates around 4 to 5%, so that's also an indication, let's say, of the inflation, but you can measure inflation in many various different ways. You can measure it based off the consumer price index of how much things are increasing in price. And this more pertains to purchasing power, but you could also go off the Fed's rate of 4% and various other metrics of inflation that there are out there. However, the one concern with this is that they did change the rules quite a while ago to reflect a different way that they calculate the CPI. So you can actually see alternative statistics here for the actual CPI. And this is what's called a pre-1980 based. So 1990 based alternative. You have the alternative in blue and then the official CPI in red. So you can see it here. It's the same chart as here, but the blue one calculates based off a different metric and calculation that they used previously. But a lot of people think that they have manipulated it so that the calculation looks lower, so inflation doesn't appear as much. However, they might take certain things out, like say coffee has increased by 250%. They might take that out of the calculation this time around for this year because not many people are buying coffee, things like that. So you can see they actually have the suggested alternate one here, and it's basically about 2 points higher than the average that you see here. So around 9%, which we saw back on this chart, is looking more around 15% up here. Same goes for here. We have it around 5.5%, but it's more like around 9% at these times. Remember, this is back in 2008. So it just goes to show that they can kind of manipulate it, and they going off based off different calculations year on year. So I would mainly regard an average between these two. So let's say that it was around 9% here, but it's around 15% here. I would say that the actual inflation rate, it's just kind of an average, let's just say 11 to 12% around this range, just because you get a best of both worlds at that point. But the reason that it's so important is because inflation over time diminishes the purchasing power of your money. So if you're saving money, and we'll get into just a little spreadsheet later on how to show this, it basically diminishes your purchasing power over time if you're saving money. And this video is kind of to push people to invest into the stock market, because there's no real way of changing inflation or invest in any assets for that matter, but there's no real way for changing inflation. At a lower level of investing, you just have to accept that it is going to happen, and then the main goal should be to try and outcompete the inflation rate through the investments that you're making. For example, you can see here the S&P 500 is up. Let's just go back to 2010. So it's at 1,024, and now it's up to 6,000. So a 6x in the last 20 years, which is actually incredibly good based off the average. If you go on the 10-year trailing average, you have around 11.72% for the last 10 years. I don't know what the trailing average is for the last 15 years, because this would technically be 15 But this one only goes to show the 10-year return. So if inflation year on year on average, let's just say go for an average, I'm going to go for the average of 4% if that's the average there. So the S&P 500 has actually outcompeted it by around 8%. So you take, let's just say 12% right here, you minus the 4% because that was the average inflation rate across the last 20, 25 years. And that gives you a percentage increase of purchasing power of around 8%. So 12 minus 4 gives you 8. And that is kind of what your purchasing power has increased over the last 10 years, let's just say, because this is only the 10-year annualized. So you can see why investing into basically anything that does increase, now there is a risk that the stock markets will go down, but if inflation continues to happen, you should see the stock market go up over time. On a long enough time period, if inflation keeps happening and there's no stagnation, then companies will receive more money and the cost of things are going up in price, and the people that are selling, the cost of things normally kicks back up to these companies into the S&P 500. So over time, you should see just an increase gradually of all the companies within that. And if you're invested in that, you'll see an increase in the money that you've made. Let's be very clear that the purchasing power hasn't increased by 12%, because if inflation is 4%, every year you are going to lose that 4% to the inflation, and the main goal is to kind of outcompete the inflation. This is why I don't necessarily agree with saving a large sum of money, just because a lot of it is lost to inflation very, very quickly over the next 20 years, whereas investing it over the next 20 years is probably going to produce way more purchasing power plus profits on top. So you can come to things like gold, which is notoriously a hedge against inflation. And that basically means that as inflation goes up, the price of gold should hedge against that inflation. So if inflation is average 4%, gold should rise in price by an average of 4%. It hasn't necessarily been that as per late, but I think gold actually reflects, so if you're going based off how much it has increased in a year, gold should reflect the actual inflation rate over the past year. So we can click here. Let's just say the inflation rate, what do they have it at right now? 2.7. So you can kind of get an idea because gold is a global market. S&P 500 or CPI indexes are selected for certain countries, so inflation might be higher in certain countries. But overall, if you're looking at a global thing, gold should reflect as a hedge against inflation, but there is going to be profits on top. At least lately there has been, because 1,600 to around 2,200 is quite an increase within the year. To get a better average, you would spread it across, 20 years or 10 years. So I want to note as well that gold also has an inflation rate. So let's just say that it does say 3% year on year, but if inflation rate is 4%, then the money that you put into gold is actually rising in purchasing power by around 1% every year. So you take that 4% and you minus 3, and that gives you that 1% that you're actually gaining on purchasing power every year. But you can see from here, average annual return on gold depends on the period being considered. For example, 1971 to 2019, the average annual return was around 10.6%. So that's actually way more than the average inflation rate as time goes on. So you can see how it hedges, but it also gives you an extra percentage on top. The same happens for the S&P 500. And as we see on the channel, cryptocurrency is the main thing that we talk about. That is also acting as a hedge against inflation, whilst producing more purchasing power for you over time. One other thing that you could stick it into is property, I believe, because mainly property just increases with the inflation rate. There's not really much added on unless there's certain things in the area that you're buying the property in. For example, if you're in a city that's growing very quickly, the price will outrun inflation for your property. But for the most part, property prices do just track with inflation rates, so it's a good hedge against inflation to buy property. It's why mortgages, at 25 years or 30 years, they have a certain rate, and they want to return more from that than the inflation rate. So it's why mortgage prices, or at least the interest rate that you're going to pay on it, is going to be slightly higher than the inflation rate at the time perceived by whoever's given out the mortgage, because they want to make money on it without losing their purchasing power as well. And it's why we have a whole cost of living crisis that is happening now, is because wages aren't increasing. The stock market seems to be doing good, which means companies are getting a lot of money. However, the actual people within that market aren't getting more money relative to how that stock price or that whole stock market is working. For example, if we click back onto the S&P 500, you can see that there's a 10-year return of around 12%. But wages haven't increased 12% year on year. That means that whilst this is also increasing, the wages aren't increasing to reflect that, and companies are charging more. And that's when you run into a cost of living crisis. There's also a lot of other factors, but an overarching one is the inflation that's going on currently. And the fact that we can't actually get real figures on this, because a lot of the people behind who actually produces the inflation rates are very set on keeping it low. Otherwise, panic forms if you have a massive inflation rate, because you could have runoff hyperinflation after that. So I've just put together a quick little spreadsheet here. So inflation is at 5%. Let's just put that as the average. In your savings, if you are saving 1,000, this is in year 1, year 2, year 3, year 4, year 5, and then we have a percentage of purchasing power either lost or gained. So in your year 1, you have $1,000, and let's just say that inflation is 5%. That means you're going to lose 5% year on year, and you can see this reflected. So you have 1,000 divided by 100 times by 95%, and then that's continued year on year, and that gives you minus 18.55% in the last 5 years of purchasing power lost. So it will appear to be $1,000, but your purchasing power has been lost by 18.55%. It's not going to reflect as $814, but that is technically how much your purchasing power is 5 years down the line if you have 5% inflation year on year on year on year. And then let's go to gold investment. So the calculation is a little bit different. So we have 100 times by 104. So as we said, the average annual return, we're going based off this, is around 10.6%. So we take 10% and we minus the 5, well 0.6 as well, we're adding that on, so it's around 104 or 105, because you're losing the 5% in the inflation for purchasing power. And this is the calculation that we're going off. We're going based off purchasing power, not necessarily the increase over time. So you have the minus 5% for inflation, and then you already had a 10% annual return, so it's more like 104% every year on year on year. And that brings us out to around $1,169, which isn't going to be reflected in the price of gold, but that's what your purchasing power looks like, 16.99%. In the next 5 years, you'll actually increase your purchasing power doing that. If we did it based on strictly how much gold increases, this number would be higher, but it wouldn't reflect the purchasing power. That's very different to how much the investment has actually increased. So if we did a little calculation here, we could just take this and we could copy it down here, and then we could copy this formula and put it down here, but we could knock this up to 10% because that's how much we're gaining every year on year annually, and it would actually reflect a figure that we see here of 1,464. So that's how much you would actually see gold increase, well, on average, let's just say, if you bought it 5 years ago. But as I said, this is based off purchasing power, so how much that is increased or decreased. And then we go to the S&P 500, same calculation, but we're using 12% this time, or 11%. So you had that 11%, and then you minus 5% for the inflation, divided by 100, times by 106 year on year. You can see your purchasing power has actually increased by 26.25%. And the same goes for Bitcoin as well. You have it at 130 just because it's a bit of a riskier asset. It can drop up and down, but on average, it's probably going to trail more towards 30% year on year. And you can extend the time frame, obviously, but you can see purchasing power is a lot higher, so 185% more purchasing power. I think as time goes on, though, that will decrease because cryptocurrency is getting bigger and bigger and bigger. And that means that this will trend down from 130% year on year to, 120, 110. And I think it will collide with kind of what we're seeing with the S&P in the next 25 years, something like that. So the main point that I want to get across is that sometimes saving your money is not the best thing overall across a long period of time. Now, this is only 5 years, but over the next 25 or 30 years, there will be ups and downs in the market, but as we saw here, there is an annual average return of around 12%. I normally invest in cryptocurrency because I know that that's going to be more volatile, which means that it's going to have a higher annualized rate of return until, as I said, around 25 to 30 years down the line, where it does become big enough to collide with the same percentages as the S&P. But then you also see gold as well, which is notoriously a hedge against inflation, which means that it should basically track with the inflation that's going on. So in theory, you should see 1,000 is equal to the same 1,000 purchasing power, but lately it has increased past the inflation rate, which is good as well as an investment. As I said, these three do go up and down, but over a long enough time period, you're going to be way better off investing instead of saving a bunch of money. It's okay to save a certain amount of money, but as soon as you go, 5 years down the line, we can already see it already. You're losing quite a lot of your purchasing power, and you can actually extend this out 10 years down the line, and you'll lose quite a lot more. So we can actually extend this down the line just to show you what it looks like on 10 years. So pretend that this is 6 years, and then we're going to drag this across, and we're going to actually move this to delete this out and put it to here. And this should actually drag across now. So 630, we do the same calculation right here. So that gives us minus 36% in purchasing power. So you've lost around 36% of your purchasing power in 10 years. You can see as you go down those years, if you added another 5 years, you'd probably see an actual doubling of that, and so on and so forth. As I said, it's good to have savings for a little bit, but investing it is the only way that you're going to outbeat inflation and kind of get ahead of the curve of inflation. Whilst everyone else's purchasing power is being lost, you can actually increase yours through investments. It doesn't necessarily matter which one you want to go with. If you want to be more safe, you can go with gold. If you want to be a little more risky, you can go with Bitcoin, which is going to produce extra money on top of hedging against inflation. So let me know your thoughts in the comments. And if you have any rebuttals to any of the points, please leave them in the comments below. I am open to discussion about all of this. Make sure you like the video and subscribe for more content like this.